So credit and in inventory management, part two. Uh, Now, credits analysis process of deciding which customer receives credit, gathering information. Credit scoring is less subjective than the five C's. Then we have to subject on these credit scoring from we're looking at their financial statements, and we can also get information from their banks, payment history with the firm. So these are the all the things that we can collect in order to make decision whether we have to offer them a credit or not. And there is also a five C's of credit we use in our common understanding about a customer when we are credit. And everywhere in the finance world, these five C's are common to apply to a borrower. What are these five C's? One is the character, willingness to meet financial obligations. What is a character of that? Is there any criminal record, or is there anything that reflects that the person is not financially suitable for doing any financial activity? So this is a one thing which we can imagine from the character of a person. The other one is the capacity, and that's also very important. The ability to meet financial obligations out of operating cash flows. So when you go for borrowing money for your car financing or for your mortgages, in that case, the banks do that analysis where they, what is the character of that person, what is the capacity of that person. That's why they ask from this your pay stubs and all these things in order to evaluate your capacity. Then capital, how much capital you are investing in that, and how much you are demanding for borrower. That's again a very important perspective. And you know that if you want to buy a mortgage in Canada, you have to pay at least 5% if the value of the property is less than $500,000. If it is more than that, then you have to contribute 7% over and above the $500,000 and 5% below the 500,000. So there is some restrictions imposed in order to protect the financial institutions, and this is a part of a credit policy that how much the capital the borrower is putting in. Collateral, that's also very important element, that what is the security or what is the asset you are behind. If in case of a default, we can recourse to that asset. This is what we call it as a collateral. For example, in a mortgage loan, the house itself is a collateral. For a car finance, car is itself is a collateral. And in some cases, the firms are buying borrowing money against the stocks and shares of other firms. So this is the way that you have to show, you have to provide some asset backing in order to buy or in order to borrow the money. Conditions, general economic condition related to customers' business. You have to evaluate in general your business perspectives. Like if someone is selling a product which in future have no market value, then definitely you're not gonna lend that. So financial statements is a source of credit information, credit reports with the customer's payment history to other firms. We have a different types of Equifax, or there is another company firm that offering this service, and we see commercials very commonly on the credit scoring. They are maintaining the credit scoring, and they report the credit scoring to the lenders who want to get a credit scoring. So banks, payment history with the company. One-time sale. If you want to sell one time, then you have to calculate. It's a one-time sale. It's not a and if it is a big item, so we have to calculate NPV. How we can calculate the NPV for a one-time sale? Minus V means the variable cost of that product. We report it as a minus. Plus 1 minus profit. Pi is a profit into P, which is the amount of a principal you are, or a price per unit, divided by 1 plus R, which is a monthly required return. So your company is considering grant credit to a new customer. The variable cost per unit is 50. The current price is 110. The profitability of the probability of the default is 15%, and the monthly required return is 10. So we see here we apply this pi is a default, and we see -5 plus 1 minus 0.15 into 110 divided by 1.01. So we get it 42.57 NPV. What is the break-even profitability? If we convert this NPV is equal to 0 and then equate these calculations. So we see that if the default is in between, if the default factor is 54.09, even then we can make a zero profit or a zero loss break even. So here the probability that we are thinking that we can lend this customer because the probability is 0.15. However, we can afford this till the probability of 0.54. So this way that we can use to evaluate the customers. Now look at the previous example. What is the NPV if we're looking at a repeat business? Now, if it is a repeat business, definitely we say. So what we are adding up here, we are adding up in this formula as a P minus V, variable cost. So repeat customers can be very valuable. So hence the importance of good customer service. So it makes sense to grant credit to almost every one once, as long as the variable cost is low relative to the price. And if a customer's default once, you don't grant credit again. Now there's a collection policy. If the average collection period is well outside your credit term, then there is definitely a problem. If you offer a discount, keep an eye on average collection period relative to your credit terms. Use an aging schedule for receivables, and which we divide it like over 30 days, over 45 days, over 60 days. And in this way, we create a aging schedule for our receivables, and then we pursue according to that schedule. Collection policy, delinquency letter, you write it, telephone calls, and collection agents if there is no possible, or you can take a legal action if the default is confirmed. Now, the last point here is that inventory management, how we manage the inventory. The inventory can be a large percentage of a firm's asset in a current asset, especially. Inventory is one of the big items in our current assets. So cost associated with carrying too much inventory, that's not good. And cost associated with not carrying enough inventory. So you have to make a very delicate balance between having an inventory and not having an inventory. Because if we have an inventory, there's a cost attached with it. And if you don't have, we lose customers, we lose sales, we decrease our sales, we can annoy our customers. So this is the way that you have to. Inventory management tries to find the optimal trade-off between carrying and too much inventory versus not enough. Types of inventories, manufacturing firms, normally raw material, that is part of an inventory, starting point in production process. Then we have a work in process inventory, that is semi-finished or half-finished or some percentage finished products, which is in the process of production. And then we have a finished goods inventory. So these are the three inventories. Like in the beginning, we have a raw material inventory, then we have a work in process inventory, and then we have a finished goods inventory. So remember, the one firm's raw material may be another firm's finished goods. That's also possible. Different types of inventory can be dramatically in terms of liquidity. So carrying cost range from 20 to 40% of inventory value per year, and storage and tracking, insurance and taxes, losses due to obsolescence or deterioration or theft, and opportunity cost of capital that you can earn interest if you are. And there's a shortage cost, restocking cost, and lost sales or lost customer cost, and consider both types of cost and minimize the total cost. So these are the cost with inventory. So you see here, there is a carrying cost if we keep the inventory level high, and there is a a shortage cost if we are not having a inventory according to. So ABC approach, which we call as an activity-based costing approach. ABC approach is a uh, activity-based costing approach for inventory management. Classify an inventory by cost, demand, and need. And those items that have a substantial storage cost should be maintained in large quantities than those with a lower storage cost. So generally maintains smaller quantities of expensive items. Like for car dealers, normally they don't maintain so much inventory because they know that it's expensive. So when you place order, they place order to the manufacturers, and then you will get a delivery after 3, 4, 5, 6. Sometimes it's a year, then you will get it. Generally, maintain a substantial supply of less expensive goods. Like for example, if you want to book some apartment or a townhouse or a house to a constructor or to a builder, you first book and then they construct. So it means that there's no inventory because these are expensive items. They cannot build. But you go to the superstore and you buy different types of products. Those are all in a huge inventory maintained by the store. So because these are inexpensive. Now, what is the last thing that we want to discuss is economic order quantity model. This is a model what we are borrowing or we are taking from managerial accounting. The EOQ model or minimize the total inventory cost. Now, this model is saying total carrying cost, average inventory into carrying cost per unit. That's an average inventory. Uh, Q over 2 into CC, which is the carrying cost. And total restocking cost is fixed cost per order into number of orders. So fixed cost into total cost over Q, which is the number of orders. So total cost is total carrying cost plus total restocking cost is equal to Q over 2 into CC plus fixed cost into T over Q. And when we solve it for Q out of this formula, so we get it like under root 2 TF over CC. So this is what we call it as economic order quantity. So here is an example to understand this whole idea. Consider an inventory item that has a carrying cost $1.5 per unit. The fixed cost is $50 per order, and the firm sells 100,000 units per year. So what is the economic order quantity? So we can calculate using the formula what we discussed, 2 into the total units into the order per unit per fixed cost of ordering divided by carrying cost, which is $1.50 per unit. So we get it like the economic order quantity or is 2,582. We order each order each term like 2,582 units, and then when they are finished, then we want to order it again. Extension, safety stocks, and a minimum level of inventory kept on hand, increase carrying cost, reorder points. So as we discuss here that it is 2,582. When we order this, we get it. And then when we order the new one, there must be some point where we call it as a reordering point. At what entry level should you place an order and need to account for delivery time? And derived demand inventory is a material requirement planning. MRP is a material requirement planning for our raw material in order to produce our product. Now, why we are discussing this inventory management? Because inventory nowadays is very expensive to hold, which is a storage cost. And for that reason, with the help of technology, whenever you buy something, the teller is scanning or the product in order to bill you for your buying or purchasing. Um, But at the same time, this scanning is not only creating a bill for you, uh, it is also hitting the at the back end our inventory levels. And as the products are going or we are selling out, the inventory level is adjusting. And this adjustment in entry level, in the systems, we have some minimum levels of, and then when the inventory level reach to that point, what is going to happen? They raise a point for the managers to reorder it, or there is a in systems, if it is connected with the suppliers as well. So there is a possibility that automatically the system is placing an order with the supplier. So in the retail business, it's very common that their system is connected, their inventory management system, as well as with their suppliers. So they are reordering. But these are for the products like uh, you are buying sugar, you are buying the cold drinks and all these things. The reason is that the demand for these products are not so that's going to be changed very quickly within a 1 week or a 2 week. It's a very stable type of demand, so we have to read it. But there are certain products, Zara is a very famous design clothing designs. So their system is also connected, and they are famous that they are manufacturing their products not in labor intensive countries, but they are producing their product in Spain with their own all these producing facilities at Spain. What they do is their system is all interconnected in a way that when a shirt in New York or anywhere else in the place is going to be uh, sold, what is going to happen? Their inventory level is affected. And when the inventory level is affected, there is already a system in place that this design is going to produce more or not. If it is not produce more because it's out of fashion or it's out of trend, so they is not going to replenish that stock or inventory. If it is in a demand and there is a system in the head office is saying that we have to reproduce it if there is a demand, then in case if one item is sold in any location within 3 to 4 days, the stock is replenished there. So that's the way that it works, because the inventory holding or inventory, and especially on those types of businesses where the trend is changing and there's a huge chances of having a obsolete or obsolescence of the stocks. So then there is the inventory management is a very important issue. So this is just an example shared with you regarding a few uh, practices in the industry. Now in the third part, which I'm going to do is I'm going to solve the question related to this chapter, and hopefully I will do it separately because it's not possible that I can solve it here with my digital pen, and that is going to be saved because of there is some I don't know, maybe it's only in my system, but in team when you write something on a PowerPoint, it's not going to be recorded. So stay tuned for my third part, which is on my screen saving at screen recording on my iPad, and I upload it. Thank you very much, and I hope you enjoy. And if you have any question, please contact and or you can write it under the comment. Bye bye.